Why are the markets showing signs of breaking down below critical support levels and shifting away from big tech? Let's dive into what's happening in the stock market and explore the reasons behind these recent developments. The S&P 500, a barometer of the broader market, is currently hovering just above 4,000 points. Recent data shows it at 4,151 points, experiencing a slight bounce but still down nearly 1% for the day. What's concerning is that it has breached the 200-day simple moving average, SMA, a significant technical indicator represented by a blue line on the chart. This breach has led to a rapid acceleration in selling pressure, resulting in consecutive red candles and the establishment of a lower high and lower low pattern. These are telltale signs of a market in a downtrend, a trend that's been developing for some time. The Nasdaq, a tech-heavy index, appeared to have some hope earlier, but unfortunately, it too has broken down further. The Nasdaq is down over 1%, with fluctuations throughout the day. The breach of the 200-day SMA at 12,750 points marked a pivotal moment, and the subsequent sell-off confirmed the downward trajectory. It's also exhibiting a pattern of lower highs and lower lows, which aligns with the broader market's bearish sentiment. If you've been following recent analysis, this downturn shouldn't come as a surprise. The markets have been under the influence of substantial selling pressure, particularly in the tech sector, where big players like Microsoft, Apple, Nvidia, Google, Meta, Amazon, Tesla, and AMD are all experiencing significant losses. These tech giants are key components of the market, and when they falter, it sends ripples through the entire landscape. A closer look at the market's heat map reveals where the money is flowing. Today, it's primarily exiting the tech sector and moving towards more defensive investments. Many companies are seeing red on the screen, indicating a sell-off. This shift in focus is evident not only in tech but also in other areas such as real estate, basic materials, utilities, and financial services. Even companies like Bank of America, Wells Fargo, and Charles Schwab, representing the financial sector, are experiencing gains on the day. Now, let's delve into a specific subset of tech stocks, often referred to as the Magnificent Seven. These are companies that have seen significant growth but are now facing pressure. The index representing these companies has declined by approximately 12% from its recent highs. From their all-time highs, it's even more substantial, at around 14 to 15% down. This could be seen as a double top formation, which is a bearish pattern, or possibly a bull flag, a bullish pattern. The direction it takes will depend on various factors, including interest rates and macroeconomic conditions. When we consider market volatility, the VIX, CBOE Volatility Index, is a crucial gauge. It's currently above 20, indicating increased volatility in the market. Historically, when the VIX surpasses 30, it often signals a favorable risk-reward profile for long positions. This suggests that as the VIX rises, the risk of further declines decreases, making it an opportune time for long-term investors. Another important observation is that while the broader market is hitting new lows, the percentage of stocks trading below their 50-day moving average has decreased. In early October, about 94% of stocks were below this moving average, while now it's around 86%. This paradoxical situation arises because the big tech stocks are leading the market lower. As liquidity exits these giants, it's moving into other asset classes, including bonds and possibly cryptocurrencies. For example, bonds are gaining strength, with various types experiencing gains. Treasury bonds, investment-grade corporate bonds, and short-term duration bonds have seen positive movements. While these are not massive shifts, they indicate a rotation of funds out of equities and into more defensive assets. Now, as we discuss the technical aspects of the market, it's essential to remember that there are no guarantees in the stock market. Every investment comes with risks, and it's crucial to conduct thorough research and analysis before making any financial decisions. But from a risk-reward perspective, there may be opportunities emerging. The risk-reward profile for long positions could improve as the VIX continues to climb and stock prices decrease. It's a time to keep a close eye on the markets, monitor developments, and make informed decisions. Comment below, everyday Americans, what are your thoughts on the recent market developments? Are you considering any changes to your investment strategy in light of these shifts in the stock market? Remember, the stock market is constantly evolving, and it's crucial to stay informed and adapt to changing conditions to make the most of your investments. Disclaimer: the information provided is for educational and informational purposes only and should not be considered financial or investment advice. Please consult with a qualified financial advisor or conduct your own research before making any investment decisions.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information, and it helps us spread the message. Sharing is caring.